so many people talk so much negative things about policies and agents and how certain agents are setting up your policy for their benefit, not really yours. So in that same example, if the max, or better yet, I need you to explain how we can max versus, the premiums and how an agent could actually get off.
How you can structure the policy properly.
Right.
Okay, so that's key. So your agent does have to be well versed on structuring a policy. That can take some time to learn. To make sure that the policy is focused more on building your cash value and not just being swallowed up by the death benefit, you're going to need to make sure that you're using a policy focused on cash value. So that's going to take us to either the IULs that are cash accumulation focused. We're going to make sure that we typically level those death benefits, because if the death benefit's increasing, guess what? The cost is increasing. So if we want the max amount of cash value, we're going to need to make that death benefit level. Second thing that we're going to do is we're going to take the lowest death benefit and we're going to put the highest amount of premium we could put in there. So in that case, we're structuring it so I just recently structured a policy for a real estate investor. They want to put $250,000 in for 10 years. Then they don't want to pay anything else. So I had to find a death benefit that will allow me to put $250,000 in
each year
okay. without it macking.
Each year.
They're a real estate investor. Their purpose is going to be putting the money in, taking it out to buy property. With the first year of $250,000 in, they were only having access to $130,000 year one after the first 30 days. Okay. But year two, it was almost like double that. Right. But again, year two, you're at $500K.
Right.
Okay. So you got to be mindful of that. But the whole thing, we leveled the death benefit. The death benefit was like 3.7 mil. This person is 53 years old. Okay, so because of age, that's why the death benefit is not super high. The younger you are, that death benefit would have needed to be higher to hold $250,000. Because remember this, when you're getting these policies, it still is life insurance. So it has to be a premium that you're paying. So you can't just dump $100K in and then you can't afford no premium.